Well, hello and welcome to Trading Blows. Plenty for us to discuss in the show this week, including what the latest incoming economic data means for the outlook going forwards, how things are evolving here in the UK after the autumn statement last week, whether OPEC are able to arrest the recent slide that we've seen in crude prices, and we'll also take a look as we move into year-end at some tips for traders trading around the festive period. Without further ado, let's get into the show. So a busy show ahead once again this week. Without further ado, let's bring in my guests, our panelists for the show this week, who have been told under no uncertain terms that they're not allowed to move at all during the recording of this episode. Joining me this week, Arno Venter from down in South Africa, market analyst at Capital Edge. We also have the newly matured Ryan Paisey, the founder of PiQ Suite, and last but by no means least, Richard Matthews, the head of FX and partnerships.
Who's extra mature.
At One.io. As always, the gents going head-to-head over 4 rounds, scoring points for a great answer, and the threat of points being chalked off looms over them if a dispute is raised over what they have to say. With all that said and done, let's get into the first round. So it's been a couple of weeks since we last recorded one of these shows, and we've had plenty of economic data come in on both sides of the Atlantic since then. So let's dig into what some of that means and what the implications are. Ryan, let's start with you. Do you think that a soft landing is still on the cards, or are we in for something a little bit bumpier given some of the softness we've seen in the activity gauges of late?
I think I feel a bit hard done by because, as I've mentioned a few times on the show, I don't think there's any landing, and I continue to believe that. We've just had PCE data come in, literally this second, as we're recording. Obviously, we record yesterday, yesterday. PCE data came in 2.3% on the kind of the more macro Q3. Q3. That's the core PCE. Expected 2.4, came in for a previous at 3.7. So that ties in with what we saw earlier on today with German inflation numbers. They came in lower. It's a case of when deflation. I think this, it's playing brilliantly into the Fed's hands because they can just sit on their hands for a little bit, and the labour market seems to be kind of coming together a little bit more in favour of kind of where everyone wants it to be. So in terms of landings, definitely no hard landing. I don't believe there's a soft landing. I don't believe we haven't seen any landing so far, and I don't foresee that we'll see any landing. It's data though, isn't it? You have got to zoom out a little bit, wait for revisions, and also one swallow doesn't make a summer. But I think the fact that we're seeing this all over the world, apart from Japan, everywhere going the same way, I think it's things are looking up. Unless you're Germany. Obviously, funny enough, so we had German data today, obviously, and so November was eased more than expected to inflation for November eased more than expected to 2.3%, which was I believe like 10 basis points lower than the market was expecting. Deflation month on month of -0.4%, minus 0.7 on the Eurozone adjusted metric thing. I'm not really sure how they do that. Arno's more technical. He might know how they do that. Which is a good thing. On a number of reasons. One, it's great for households. Hence why stocks took a bid in that, because obviously it means that the ECB or the Fed or whoever are less likely to, increases the likelihood of them cutting, right? Which if you're German, is what you need, because the German data recently has been absolute tripe. They're screaming for they need rate cuts, especially if they're going to if they're removing the debt brakes, they're going to be looking to borrow more. They want yields as low as possible. I'm not going to sit here and tell the Germans that I told them so, because I don't know what it is in German, but I told them so. I did that. Give me a point for that.
You've got a point for that. Well
thanks, thanks. Because I was screaming when we were negative yielding that they should be borrowing as much as possible when it was negative yielding. I mean, when you were being paid to borrow, basically, what, Austria and all that, they had the right ideas about 100-year bonds and negative rates and all this stuff. Why more? I just do not understand why governments weren't borrowing up to the hill. I'm not saying they should have spent it all at once, but at least lock in that borrowing and have that on your side. That didn't happen. Germany, maybe because of the debt break, they couldn't issue it. But when rates are, you understand why there's a debt break when when yields are 5% or whatever. Then you do not want to be borrowing stupid amounts of money. But when yields were 0%, negative percent, right? There should be no debt break when that is the case, because it actually works against you, which is what we're finding now. So like Germany now are in a massive pickle. So anyway, I've kind of digressed a little bit on a kind of like anti-German rant. But I think data's coming in fine at the moment. I'm liking what I'm seeing. I think we're going to continue to see more of it. I think maybe on the manufacturing side and kind of an actual what's going on within Germany, I think we're going to continue to see that weighing on the euro, especially as the chances of an ECB cut in Q1 increase, which I was laughed at last week or week before when I mentioned I see ECB cutting very soon, but it's going that way. It's just kind of trade-offs.
There does seem to be a bit of a consensus forming around that Q1 idea. Someone else mentioned that to me earlier. I can't mention their name in the show, but if you go and look at my Twitter feed, you'll see the conversation and you'll realise why I can't mention them. But I do highly value their opinion. I think it's interesting. You actually put something out, Ryan, the other day. I think it was you anyway, that said you're old enough to remember when Southern Europe was the problem. I mean, how times have changed. That we're now dealing with Greece repaying their debt early and Germany in the doldrums.
But the best thing as well was that Greece. So if everyone, I suppose most people won't remember, but when Greece was in a right pickle, when we had the Eurozone crisis, German politicians were with a straight face. Well, obviously Germans don't do humour.
Oh God!
But with a straight face, saying to Greece, well, maybe you should sell some of your islands and help pay off your debt. And we had a Greek politician, an ex-Greek politician, but he was a politician at that time, turned around yesterday and said to German government, hold up, why don't you sell some of your islands and dig yourself out of this fiscal hole you got yourself in? Which I think is fantastic.
That is brilliant. Right, Mr. Matthews, let's bring you into the show. You haven't been here for a couple of weeks either. What are your thoughts on what's going on in terms of the economy at the moment? Because if you look at some of the commentary that's been coming out, we've had maybe this US exceptionalism theme seems to have died down a little bit, but literally as we hit record, we had third quarter GDP revised up north of 5% from 4.9 prior. So have we all got a little bit too pessimistic too quickly?
No, I don't think so. I think the US actually is still an exceptional economy. I think it's by far the strongest. To me, it defies logic, probably defies gravity if you're looking for a landing. I don't think you'll get a soft landing. I think you're going to get a slow landing. It just glides along happily. I think the data is pretty clear that things are slowing down. I think there's certainly a huge difference between what's happening in the US and over here in Europe. And I'm including the UK into Europe, which I really shouldn't say, in the UK and Europe. I just think to me, it's absolutely amazing what the Fed has done. And I guess maybe we're comparing it to previous business cycles. We've had 15 years of extraordinary behaviour by the central banks, pumping money in for financial crisis and COVID and whatever. And maybe it's not fair to compare it to previous business cycles.
Sorry, Dickie, was that you being complimentary of a central bank?
I think it was.
I like the Fed.
Okay, right.
I always like the Fed.
I thought maybe I was going a bit senile.
No. Wait till we get on to the UK before I really get going.
Someone's at the door.
I think that the Fed's done a really, really good job. On the face of it, you're gonna, as I say, you're gonna have a slow landing. I think there's still some worries out there. I was probably, thankfully, overly pessimistic about what was happening in Israel, but I'm sure we'll cover that off later on. I think people are pricing in cuts in the Fed much too early. I don't think you're going to get a cut probably till the third quarter next year from the Fed. However, I do think, and I've been saying for ages, I think the ECB is going to be the first one to cut and run. Whether Germany's got the influence in the ECB that it once had, I'm not quite so sure. But I think they'll fold very, very quickly, and they'll cut. Bank lending slowing down, and interestingly, it's slowing down in Southern Europe more than elsewhere, which, looking at Germany, is absolutely amazing. Germany is an absolute basket case. I think it's just mullered, excuse the expression, from all sides. Chinese exports have disappeared. China's flooding them with electric vehicles. They're still very vulnerable to Russia. Oil will come on to later on, but I think winter's coming. Certainly, it was coming in the English Channel this morning when I was in there. It's bloody freezing. It's probably 3 degrees colder than it was this time last year, the water, which is a huge difference.
You went in this morning? You went in this morning?
Yeah.
Blimey.
But it really, really is much, much colder than last year. Whether that's the forerunner of a really harsh winter, I don't know. The pattern is record snowfall in the Alps. Having said that, the sun just comes out and bathes me as I speak. I think it all looks good. UK, I think, is different. I'm not convinced inflation's beaten here. Don't make me talk about Bailey so early. I think we've still got problems. I think what Hunt did last week, which we'll come on to in a minute, is not that brilliant for us. But all in all, I think, it looks like a miracle to me. And, it's like Spurs winning the championship for the last 2 years.
Don't.
Well, I'll tell you what, Dick, hold your thoughts on the UK. We're going to go to Arno, and while we're doing that, I'm going to send a doctor round to check on you, because this optimism is very, very unusual coming from your part of the world.
Must be just Christmas is coming.
It must be. Arno, welcome to the show, mate. How are you doing? And more importantly, I guess, we've looked at how the outlook is differing on each side of the Atlantic. Are there any divergences that traders can actually start to look to exploit here?
Well, the thing is, I think, we know US exceptionalism was a key theme, and that is starting to die down a little bit. But I do think the markets are getting too ahead of themselves with that view. If you take a look at the recent data, there is absolutely nothing in the hard data to suggest anything close to a recession at this stage. It looks like a
unless you're in Germany,
unless you're in, for the US specifically.
Yeah.
Germany is one of those cases where it's pretty bad.
I love that we've all agreed that Germany is completely fucked.
Brian, don't start moving your arm like that when you're talking about Germany.
Oh no!
Oh no!
Arno, talk. Go.
Talk. Carry on.
Anyway, in terms of the data. Nothing in the data, I think, suggests that the US exceptionalism is done at this stage. I think it's still, very positive. Look, the data has been mixed. If you take a look at the housing market, which so many people are looking at, everybody that wants a recession is focusing on existing home sales and the NAHB, which, existing home sales came in at the lowest pace, I think, in since 2010, which was pretty bad. But at the same time, because inventories have been so super low, you've actually had housing prices, which is up year over year. So, if you're selling your house right now, even though existing home sales are down, you're making money on your investment. Building permits is up. New home sales is pretty much flat. If you look over to the labor market, there's been a lot said about, I think, initial claims and continuing claims over the last 2 weeks. But I think it's so easy for us as market participants to forget that Q4, whatever you see in Q4 from a initial jobless claims perspective, you need to take with a huge pinch of salt, because you have a lot of seasonal adjustments that goes on in Q4. Apart from that, there's clear signs that the labor market it's slowing, because if you take a look at the divergence between things like your cyclical and your non-cyclical employment, cyclicals have actually been pushing lower. I think we're below pre-COVID levels, if I'm not mistaken. But the labor market isn't collapsing, right? It's like every time we get a fairly okay print, it's like, see, I told you, we're going to get that bad recession. But the labor, look at where the unemployment rate is at. This isn't, it's like end of the world type of stuff when you get a 200,000 NFP print. So that isn't bad. Look, CapEx is a little bit of a worry. CapEx isn't looking great going into Q4. If you take a look at the softer data, like the S&Ps, manufacturing was down, services was up. Consumer confidence, I think, had the first tick up in 4 months yesterday. So overall, I just think that right now, the idea that the exceptionalism is done for the US, I think that's a mistake. At least it's not in the data, right? Unless we start seeing some seriously good data coming out of China, which is possible, but we haven't seen it yet. Until we start seeing China.
Anyway.
Well,
you can't. It's going to be made up. It's going to be made up good data, right? So, but if that comes in really good, I suppose that can take some of the shine off. But right now, there's just very little to compete with the US economy, and I think that remains the divergence to watch. And I mean, to Dickie's point, I think the markets are way too aggressive in what they're expecting. We spoke about this 2 weeks ago as well. By March, where do we think inflation will be in March? Let's just for argument's sake, say we are close to 2%. If growth at that stage is slowing, but it's not terrible, why would they cut? They don't need to cut, and if they then, let's just say they do cut, then if they do, that's going to be so positive for the economy. Lower borrowing costs, you're going to have valuations through the roof. You're going to have consumers ready to spend again. So there's a bit of an inflationary risk if they cut too soon, which I think is something, that could be bad. But right now, I don't know. I don't see the doom and gloom about the US. I think if there's a differential to play, it's still that one until China's data is made up better.
Yeah, it's an interesting one, and it's odd that we're all so positive. Sorry, go on, Ryan. Very quickly.
Just on this point, just really quickly, I think he's made a fantastic point about why would the Fed cut. I think if the Fed do cut, and we're in that situation, that Goldilocks, inflation's down at around 2%, or at least it's definitely continuing to head that way. Growth is still, we've just had that upward revision. If they did cut, it would show you that they've kind of self-applied a new mandate that is to pump the economy.
Yeah.
Central bank's mandate isn't to pump the economy. It's basically just to keep everything stable and keep it ticking over, right? They shouldn't be looking to kind of degrade the economy or upgrade the economy. They should just be there as, just trying to keep everything together based on the policies that governments set and all stuff like this. Otherwise, we just get into more borrowing bubbles and stuff like that, which is what we've had in the past.
The Fed's got two mandates, isn't it? To employment and inflation. And that's never going to pump the economy coming into an election.
Exactly. So if they did cut and we're in that Goldilocks zone, it would show more than anything else that basically all credibility's gone out, and all they're looking to do is trying to pump up that bottom line of GDP, which isn't their business.
Right, you're not going to get any more points, so you might as well shut up.
Yeah, good point.
Well, I was going to say, we could also talk about that all day, but we've got three other things that we need to get onto. So let's roll into round two. Right, so it was the autumn statement last week. I can tell he's been itching to get his teeth into this one for a while now. Mr. Matthews, unleash yourself. What are your thoughts?
Hello. Itching so much, I've even put a new set of teeth in. I'm absolutely petrified talking about this and mentioning the Chancellor's name. Anyway, Hunter Reeves. I suppose we've got Hunt at the moment. I think he's, whether by accident or design, he's actually managed to deliver something quite clever, which completely screws the incoming Chancellor over, who I presume will be Reeves at some point early next year. I think that he runs the risk of reigniting inflation by giving some money away, national insurance cuts, this shocking idea of giving pensioners more money. Whoopee! Thank you very much.
Sorry. Hang on. Who's paying for that, Dick?
I am. I pay tax.
Also, are you a pensioner? You're not a pensioner, are you? I thought you were like...
But hard to believe. 48 years of age, I became a pensioner.
Right, almost there.
All joking aside, I think that Reeves actually is going to face an absolute mess when she comes in. She can't reverse his policies. I don't believe he's clever enough actually to have done this deliberately. I don't think they really do that much. They might pump a little bit of money into the economy. I think that's his powder now dry. I don't think there's any more money there. He could well leave a letter for the incoming Labour Party. I think it's an electioneering mini budget. I suspect that Sunak will go early. I wouldn't be at all surprised if we see an election in May. He'll get absolutely murdered in it, regardless. And then you get round to what's Hunt basing his figures on. My second favourite set up in the UK, the OBR. Who on earth The only people more unreliable than the OBR are the Chinese with their data, and probably John Terry with women. And it's just, how can you have a £60 billion swing in 5 weeks on their estimates? It's just ludicrous. He's just gone in there and said, I want these numbers to come out. I think. I don't know. I give up with this country. I think it's an absolute basket case politically. Economically, funnily enough, I don't think it's quite so bad. The only good I've seen in the UK is the House of Lords telling the Bank of England not to get involved in climate change, which I think is very, very good to see. And my last piece is bloody Andrew Bailey telling people that he's well aware of the less well off. Well, it wasn't long ago when he was telling people not to ask for pay rises. Anyway, I'll shut up now.
Well, there we go. That was what's that say there? 21 minutes with Dick's optimism managed to last this week, almost a third of a show. So that's got to be some sort of a record.
Christmas is coming.
Right, Arno. What are your thoughts on the pound? Stepping away from the economy for a second, because cable's back up 126, 127. Is this all a dollar move, or is there anything here within the UK data, or what the Chancellor had to say, or what the BOE have been saying recently around pausing for an extended period? Is there anything in all of that that could see these gains continue, or are you sat there going, this is a rally just to sell into?
Yeah, pretty much. I think if you
look, I gave you two options. So
I was going to say, what was that?
Look,
it'd be nice.
If you look at the recent moves, I think it's been twofold. I think it's dollar weakness, firstly, and secondly, there's also some positioning in play as well. It has been looking a little bit stretch on the downside. I think that saw a little bit of an evening out, a balancing out. I think that's the main reason for the pop to the upside. Like Dick said, the economy isn't doing bad. We'll get to that in a second. I don't think anything in the OBR, anything in the autumn statement or what the OBR said is at all important for the pound right now. I mean, if you take a look at the details under the hood, there's more headroom. But that's not going to matter if that stays, flat over the next 5 years. Sure, there's the cut to the insurance that was good, higher universal credit. I think there's higher living wage as well. Is that going to have a big impact on growth? Probably not. Maybe more of an inflation concern for the BOE, maybe later. But where we are right now in terms of sterling, I think nothing politically or economically really mattered for sterling last week. I think it was all driven by dollar weakness, a little bit of positioning being flushed out. Versus the euro, though, it's a different story. I've been on the wrong side, or right side rather, of euro sterling downside in the recent weeks, but not sure whether I want to chase it much lower from here. That's the only thing that I would like sterling against. There's some crosses that could be interesting. If you take a look at the pound Aussie, pound CAD, pound Kiwi. Kiwi interesting with the RBNZ statement a little bit earlier today. Came in slightly more hawkish than expected, as you guys know. For the CAD, we've got some interesting data this week. So, if GDP can come in much better than expected in Canada, and maybe the labor market as well, then maybe some pound CAD downside could be good. The pair, I think, has gotten a little bit stretched at these levels based on the pure fundamental outlook, especially with the US. Everybody's assuming Canada is going to do far worse than the US. And a lot has been priced in for the CAD, but the overall data hasn't been that bad. So I think the markets are getting has gotten a bit too pessimistic on currencies like that, especially versus something like the UK. But yeah, bottom line is I don't see anything, from a political perspective impacting this sterling move. The market was pretty much unchanged. It was really dollar driven and a little bit of positioning, especially if you take a look at euro sterling.
Yeah, significantly less eventful than last autumn's fiscal event, I think it's safe to say. Ryan, you are the Trading Blows resident sterling bull, so you must be smiling like a Cheshire cat at the moment.
Mate, always, you know me. Can't get it off my face. The smile, that is, the smile.
Not the cat.
Not the cat. Yeah, like, well, yeah, I don't want to say I told you so, but I can in English, so well, I told you so. But there'll be some business-friendly fiscal policies come through from Mr. Hunt, which, you know, I'm sticking by that. We did, you know, national insurance dropped. Yeah, there also, what I thought was quite interesting was the fact that they're obviously rushing this through with an eye on the next election, because rather than it coming through, you know, in March, April, May or whatever, they're going to try and rush this through to for a January start, which in terms of how quickly governments move and how policies come in, I think this is kind of quite an ambitious kind of goal, but, you know, it just shows you how desperate they are to, you know, tee up for an election. And I think Dickie's right. I think our May election is probably on the cards. I think
Conservatives win.
I wouldn't bet. I wouldn't bet on it, but, you know, I'm a Tory, signed up, card holding member. You know, doesn't make me racist, which, you know, but apparently you are if you're a Tory. But it's an odd one. I do fancy if we're talking about the politics of the UK at the moment, I do fancy that we do need a change. We've had how many years? Over a decade now of Conservative government.
13 years, I think.
13 years, right? So we probably do need someone else. We do need Labour to come in, if only to show...
No, we need someone else. We don't need Labour.
Oh, yeah, exactly. Well, anyone. Look, someone needs to come in, basically, to put some other policies in place that will probably also be as bad, and then people can see that, hang on, this is just the world we live in at the moment. I think everyone, you know, no matter where you are, it's very easy to forget that a lot of what's going on in your life or your local economy or whatever is, you know, as an effect from the world economy or the world that's going on. You know, it's most people on the street don't know this. So look, I think it's good to, you know, get out the, you know, it seems odd saying this because I am a Tory, but I think it'd be good to get them out for a period of time, 4 years, and then probably they'll come straight back in. But because I think you need it, you need that clear out every now and again.
Yeah, just to freshen things up almost.
Exactly. I think, you know, despite the new tax cuts and whatever that came in, I think it's, you know, it's important to recognise that the overall burden of taxation is still on the rise, and it's predicted to rise in each of the next 5 years. And we could be hitting a post-World War II high of 38% of GDP, which, you know, is still low when you consider some kind of countries out there, but, you know, it's manageable. Yeah, minimum wage has gone up, which combined with the tax cuts shows you that inflation really wasn't even registering on Hunt's kind of radar when he's putting this together. Is that because he doesn't think inflation is a problem going forward, which personally, I don't think it is? Or is it because he's like, fuck it, I don't care. Next government's coming in anyway, let's see what happens, which is probably more likely. But yeah, with this in mind, and also the fact that I can't see the Bank of England cutting for the foreseeable, I'm still bullish sterling. Primarily, like Arno, I think we agreed on this last time I was on, that against the euro, definitely. Why wouldn't you be, really? Yeah, I don't like it against dollar purely because I'm not sure what the Fed's going to do next. So, yeah, if you were trading currencies purely on a rate differential basis, I think you stay long sterling euro or pound euro, whatever you want to call it, or short euro sterling, or you know what I mean. You know where I'm getting at with it.
For once, we do.
Yeah. But yeah, I wouldn't be touching it against the dollar purely because, you know, we know anyone that's claiming they know where the Fed's going to go next. We know they're not going to hike. We don't know how long they're going to pause for. And I don't think there's anyone out there right now that knows. People will say they know, but you do not know what next month or you don't know what Q1 data is going to be. So just cut the bullshit. You do not know when they're going to cut.
That's also why your 2024 outlooks that you get is completely useless. You know, it's like,
you know what? I was talking to someone the other day. You know, I've been in this game not as long as Dickie, but I've been in this game for like 21 years now. So, and I've seen obviously 21 year ahead macro forecasts. When I was new and naive and young, I used to love reading through them. But you know, as you kind of wise up, you realise that the people writing these must hate doing them because they know as much.
We do. Yes.
There you go. They're just pointless. But you're told by your superiors. You're normally told now by your marketing team. Look, you need to put out a year ahead.
Yeah.
No serious analyst wants to do it, but they've got to do it.
The year ahead outlooks, they are good for two things. One, the pictures in them, they're often quite pretty.
There's some great toilet paper.
And that as well. But you can't print them off these days. You've got to be environmentally friendly. The second thing is actually a lot of strategists this year, myself excluded because I'm not creative enough, but they've actually got quite creative with their titles. They're producing a few laughs here and there. But,
and I think that shows you how it's become now more and more just a marketing opportunity, right?
Yeah, it's entertainment.
Yeah, that's it.
Exactly that.
More fun looking at titles on Kindle.
It's true.
Well, I was going to say,
Tinder.
Kindle, not Tinder.
Titties on Tinder.
What's Kinder? Is that right? It's a German egg, isn't it? Kinder?
Oh, sorry, we're digressing. There you go.
I'm talking about that offline.
I think that's probably wise. What's also wise is if we move on to the next topic, I think. Well, Ryan better stop texting you because this is his second specialist subject, as he loves to tell us when he started in the markets all those years ago. Ryan, what is going on with crude at the moment? OPEC are meant to meet on Thursday, so today, when this goes out. They were meant to meet on Sunday, but for whatever reason decided that they couldn't be bothered to. Brent and WTI are both 15-20% off the highs that we saw when conflict broke out between Israel and Gaza at the start of October. So, I mean, is there anything at this point that OPEC can do or are likely to do that's actually going to put a bit of a floor under things?
So, firstly, I'm not one to say I told you so, but...
for goodness, how many times are you going to use this?
Points off for that.
It's very rare that I make right calls. Yeah, so when I make a right call, I'm going to be all over it.
It'll be 6 months until he can say it again.
Yeah, exactly. So I did say that if I could be long or short crude, I'd be short crude, and we've continued coming off. So OPEC plus, OPEC Infinity, whatever you want to call them now, it's just becoming a parody of themselves. They should have met virtually on Sunday, the 26th of November. They're now apparently going to meet my tomorrow, your today. The reason for the delay is there's been a disagreement over output quotas for primarily the African producers. They're, rightly so, they're saying, look, you've made, to the Middle Eastern countries, it comes down to you've made money pumping whenever you wanted. Now we're in a position to pump. We need to make some money. You can understand their argument. You can also understand OPEC as a whole. If everyone's doing whatever they want to do individually, what's the point in having the cartel? And I think we're seeing this as the years go on, the cartel is being more and more fractured. And again, so this is why it's incredibly important for OPEC to only come together when they believe they already have an agreement. And that's what we're seeing now. It used to be during the war. It used to be that you would get the OPEC, you get the OPEC meeting, and then they would have, so basically it's a 2-day event. It used to be a 2-day event. First day, they basically kind of go over everything. Second day, flesh out a few things, and then, come up with their decision. But now it's become so fractured that they can't do it within 2 days. So they're becoming a laughing stock. So what they're doing is they're only coming to the market or coming to the meeting per se, when they already kind of have an agreement. And it just shows you how frail the whole thing is. I think ING made it ING said it far better than I can, because as we all know, I love a bit of a waffle. If OPEC plus failed to come to a preliminary deal to continue cutting this week on Thursday, there's a risk of further delay. If we see any delay headlines from now, crude the arse will fall out of it. Because it just shows.
Is that how they put it in their note?
Oh, sorry. No, sorry. I paraphrase. Sorry, I paraphrase. See, look, if I wrote notes, that's what they'd be like. They'd be much more entertaining.
A Dutch word.
What, paraphrase?
No, arse.
All right. So basically, it's like the OPEC are in a mess. If OPEC say they're going to come out and stick to the current kind of trajectory of cutting, I think that would be bearish. I think to get some decent pump into the market, pardon the pun, they would need to cut quite significantly. But even then, I think any spike in crude that we get will be short-lived, because it will just show you how bad that they see that the physical need for crude is. I really think they're in a bad place at the moment. I think crude is going to be on its arse for the foreseeable. I'd be selling rallies. If we get any headline rallies, I definitely would be fading them. As me and Arno mentioned, I believe it's last week or the week before, we're seeing, when you get breaking news headlines about something blowing up or whatever, those spikes that we're getting are far less than we used to, and the time it's spent above where the price is above where the headline came out is becoming less and less. So again, it's just, for me, I'm selling rallies. And also you got to kind of look back as well, and when you think about so it's one thing for OPEC to say, okay, we're cutting to this level, but the compliance level of that cut is getting worse and worse every time we see the data.
Yeah.
So it's no good. What we're seeing at the moment is, say, Saudi Arabia saying, okay, we're going to cut 2 million barrels per month. Great, awesome. But then the data comes out and they've only cut 1.5 million. So these compliance of the quotas are very important. And I'm not going to say it's nothing for as a day trader, you're not going to make any money off knowing this. But just if you know in the back of your mind that what you're seeing on the headlines and what you're seeing through the news ticker isn't the full story. So if you see a cut of 2 million barrels a day, or sorry, not a month, it was a day, don't instantly think, oh, that's massively bullish, because there's far more going on, behind the scenes.
Yeah.
One thing just to quickly flag as well, it's oil related, but it's not OPEC related. And this possibly would explain why we haven't sold off more in oil this week, is because there's been a really severe storm in the Black Sea, which has disrupted about 2 million barrels a day of exports from Kazakhstan and Russia. Again, no one's really talking about that. But if that wasn't there, that's an extra 2 million barrels a day hitting the market. So we would be a lot lower. And it just all plays into my kind of bearish kind of oil thesis at the moment. Anyway, there we go.
Well, I think that was very, very well put, Ryan, in your own inimitable style.
Hang on, I've got to Google that. I'm not going to like it, am I?
I feel a bit sorry now, because I'm going to say, Dick, is there anything you would add to it? I'm not sure there is anything you can add.
Well, yeah, there is actually. I will add that my favourite central banker, Andrew Bailey, did come out last week and warn about higher energy costs on the very day that oil hit a 20% retracement from its September high and entered into a bear market. I mean, Gordon Brown levels of skill, I think that.
I don't understand how they do that. You would think they would at least look at
Bailey.
Oh yeah,
I can't understand how he gets out of bed.
Do you know, it is actually quite remarkable to be that wrong that frequently.
I mean, just look at a quick chart. If you're going to comment on anything, look at a quick chart.
Well, Ryan, try it. Absolutely stunning that he came out with that. There's very little to add to it. The Guardian and Channel 4 talking about Saudi trying to rig the market. Well, there's a bloody surprise that those two are talking about it anymore. It's a surprise that Saudi's trying to rig the market. They're bound to want to try and squeeze oil higher. Interesting, though, that the four of us don't really think that we're heading into a recession. We think we're heading for a soft landing. A recession should push oil prices down. So why are oil prices dropping?
Exactly.
Weaker demand, which you would point towards a recession, but we don't think there's one there. So, there's that, which is slightly concerning to me. But to be honest, the thing which I'm happiest about the most on my cheery day today is that I got the market so wrong about oil when this dreadful war between Hamas and Israel started. I could just see Armageddon happening, oil getting squeezed up above $100 a barrel, Straits of Hormuz getting shut by Iran, etc., etc., etc. And I am so pleased that hasn't happened. Touch wood, it doesn't happen. Really, really hard to call. People are talking about El Nino. As soon as you talk about El Nino, you're sort of really scrabbling around for anything to talk about. I don't know. I can't see what OPEC can do. Cold winter coming, as we talked about earlier. I haven't really got much to add. I think, Ryan's basically stolen the whole thunder.
Well, I think he has. It's interesting you mentioned El Nino. I was learning about the impact of El Nino on Australian beef prices yesterday, such is the interesting life that I lead at the moment.
The
one thing I will add, olive oil is absolutely at record highs and has doubled in the last year. So if you're going to trade oil, trade olive oil if you want to be long.
Well, there you go. There's a Trading Blows spread trade for you. Short crude, long olive oil.
That's it. That's the one. Don't mix them up, though.
No, don't. Arno, I appreciate this is probably even more difficult for you, given all the ground we've covered thus far. But is there anything at all you would add on the matter of oil and the OPEC shambles that seems to be unfolding?
Well, firstly, coming back to beef prices,
no would have been fine, mate.
I'm flying to Australia in a couple of weeks' time, so we need to talk about that offline if I need to know anything about
No. You can talk to Westy. Don't talk to me.
Okay, I'll do that.
I've been through it once.
I mean, being the geopolitical expert that I am, I'm always delighted to answer your questions about oil and the OPEC Plus. Look, I think the first thing from a trader's perspective, right? I think that's probably the most value I can add to this point. From a trader's perspective, the first thing that you need to know about OPEC, like Ryan already said, is you can't trust the headline. It's so often that you hear something coming out from a so-called delegate, somebody important saying something that, oh, I overheard this person saying that, and then oil prices tanks or it rips higher. And then 15 minutes, 20 minutes, 30 minutes after that, you get an entire reversal of that with the person saying, oh, but I actually didn't mean that, or I didn't say that. So whenever you whenever you do react to a source's OPEC source's piece or whatever, just have your wits about you, have your squawk turned on, because you are more than likely going to get a reversal of that move if they push back against it. They love playing with the markets. I think sometimes they release stuff like that pre-meeting just to see how the markets would react based on the decision they take. But anyway, that's just the conspiracy.
No, mate, it's not a conspiracy. It's absolutely true. Yeah, they love a weather balloon. They absolutely love a weather balloon to see what happens.
Because they always push back on it. It's like they say something and then, oh, but actually, I didn't mean it that way. So that's the first thing to know. I don't trade those headlines because I normally lose money when I do. You're
not a fan of the pushback?
Well, look, okay, I stepped into that one pretty bad. Okay, anyway, the other thing that Dickie mentioned, which I think is, this is for me really the most interesting thing.
Andrew Bailey.
The other one, about demand. Is that demand and prices doesn't seem to be flowing with demand outlooks right now. If a softish landing is the broader consensus view, and rate cuts across major economies is expected, and China's made-up data is expected to be better. If all of that is true, then demand-driven oil price declines doesn't really make a lot of sense right now. So on the one side, we've got markets doing well because the economy is doing well. On the other side, oil is doing bad because the economy is expected to do bad. So I'm not sure how that demand disconnect comes in. That's why for me, I think a lot of the downside we've had has been risk premiums being priced out. We had a big rush higher, risk premiums being flushed out of the system. Positioning is also something to keep in mind. I mean, it's very stretched at these levels. Now, I normally don't just react to stuff like that. But as you know, I had a discussion with Hill Towers Tracy a couple of weeks ago, and she said, listen, that the positioning change has been so dramatic for them. That's a little bit of a warning sign for further declines, but obviously that in itself isn't going to drive it higher. So for me, the weird thing is just the demand outlook. It seems like oil prices is moving lower for the wrong reason, if that makes sense. That's something I can't really get my head around, which is a little bit weird for oil prices. But in terms of directionality, you know what? If Saudi comes out and extends their voluntary cuts to maybe the middle of next year, or they double it, maybe that could be enough for a good trade. But like Ryan said, anything short of that, I don't know whether it's worth getting involved at these levels.
Also, it's important to remember that they have this meeting now once a month. So even if they said do it in 6 months, or we're going to do it for the next 6 months, they can change them. It's like the Fed's dots. They can change them. The dots move. It's not like they're locked in.
Yeah. Yeah,
exactly that. Right, let's get on to the last round of the show. was hoping Kyriakos would be a little bit quicker on his button there. My fidgeting around was caught on camera. Right. In the interest of fairness, I think it's probably only right that Arno and Dick go first this time around. We remarkably only have 4 weeks of 2023, 4 proper weeks of 2023 left to go from a market point of view. So, I mean, it certainly feels like the year has thrown by. Arno, what are you, relatively quickly, in the interest of time, because we've covered a lot of ground today, but what do you think are the big sort of risks and maybe even opportunities that could lie ahead in those 3 weeks or 4 weeks that we've got left?
Time off.
Give him all the points.
Very good answer. Well done.
I think that's the bottom line. Look, as a mostly risk event trader, I think the most important thing to keep in mind about year end is super low volumes and crap liquidity. Now, if you're trying to make money out of risk events, you need good volume and you need decent liquidity. So with both of those things being drastically worse and will get worse the closer we get to Christmas, you would expect very choppy conditions. You would expect very range-bound conditions. And the other thing is that, because volume is so low and liquidity is so crap, if you do get massive events that shocks the market, you tend to see much bigger reactions that you would normally do. And if you're the type of trader that looks to fade those types of events, that can be very, very dangerous for you. Similarly, if you're a trend trader, if your system is purely based on chasing trends, then Christmas is a dangerous time for you because you tend to see more range-bound, choppy markets. So again, that's something to keep in mind. Basic things that I trade by when it comes to December. Again, holiday markets is probably the best markets for losing money. So if that's your aim, trade away. Trade as much as you can. But if you like preserving capital, then it might be best for you just to, be very, very selective with what you're going to trade. Again, if the market is expected to be choppy and range bound, might not be a bad idea if you're going to trade. Maybe just drop down that risk a little bit. Don't throw away a good year by trading unnecessarily in these times. I've worked with a lot of traders, especially on the retail side specifically, that they take time off because they want to trade in December. It's like, that's the worst decision you can make, right?
Yeah, take your time off in December.
Spend that time with the family, because you're just going to end up, if you love losing money, again, then, trade away. But it's going to be very difficult for you to trade in December. It's just a crappy time to trade. And resist the urge to try and, if you've had a bad year, don't try and make up for it in December. If you've had a stale year, again, don't try and make up for it. Yes, you can have big moves with the Santa rallies and all of those things. You know what? If there was a consistent way to make money out of it, people would have done it. It's not that easy. It's not that simple. So my opinion would be just be very, very careful. This is not an ideal environment to be trading in. Christmas time.
Yeah. No, I think it's very, very tough to disagree with anything you just said, to be honest, mate. Dick, what are your thoughts on the next 4 weeks? I mean, obviously pretty grim trading conditions we would expect, but any surprises that are potentially on the cards, perhaps?
Ryan behaving himself at our Christmas party?
Not a chance. Not a chance.
Michael organising it.
Yeah, well, yes, that is true. I do need to organise that.
I'm interested that you think there's 4 weeks left. I don't think there's 4 weeks left. I think there's probably 3, 2. I doubted people. I think you've got non-farm payrolls next Friday. I think people will lock up their trading books on 15th, 16th of December. And if they've had a good year, great, go away, celebrate. If you've had a bad year, don't chase it. As Arno says, you're not going to get it back now. No. I was interested to see that Pepperstone, I guess it was Chris, was saying that the dollar's fallen for the last 6 years in December.
No, that was not Chris. That was yours truly. I'll have some credit for that.
So, if I was
you might get a point off now.
Well, if I was going to pick a trade, I'd follow what Mike was saying, because over the last 6 years, the dollar's fallen, and then one's got to think that, it's going to be seventh heaven yet again with the dollar falling.
You've redeemed yourself now.
Thank you very much. As always, I listen. I doff my cap to my young advisor. One of the things I think are quite odd. Just going back to about oil, I to me, it is really, really strange that the oil price is low if we're not talking about a recession, which we've all agreed we're not talking about. I think VIX is ridiculously low, despite what I've said about how optimistic I am about Israel and Hamas. May that truce last as long as possible. I can't believe it will last indefinitely. I still think there's some vengeance in the thoughts of the Israeli government. So I could see that coming back. I mean, VIX is at its lowest level since 2020. It just seems,
yeah, all the way before COVID. Yeah,
it just seems bonkers to me. COP28, that's going to do nothing except bore people. Santa rallies, bloody boring. I've got very, very little to add. I think it's a really, really dangerous market. It's thin markets. Stay out. Go and have a good holiday. Good Christmas, and come back refreshed in the new year.
Very, very sage advice as always, Mr. Matthews.
And I just will say, actually, talking about sages, how sad it is to see such a great investor as Charlie Munger pass away. And if I had a cap on, I'd be doffing it to him. A marvellous, marvellous man. What a life. And hats off. And it did amuse me on Twitter last night, someone saying, I'm now better because I've got more of an edge. But I don't know whether anyone else saw that. And I just thought it was a bit of a crass comment. But yeah, one of the all-time greats. Feel sorry for him, for his family, and actually probably sorry for Warren Buffett.
Yeah, absolutely. Very, very well put. And one of the great investors. And also, I mean, of course, thousands of these articles have now been published. But as you say, an incredibly sage and wise man, if you go back and read some of the quotes and things he said, not just recently, but, in the last sort of 40 or 50 years. So, I'm sure all of us echo your sentiments there. Thank you for bringing that up. Ryan, last but by no means least, we'll wrap up the show with yourself. Is there anything you would add in terms of advice or guidance for folk over the festive period? And please keep it to markets, not what you do.
Can you rephrase that? Please rephrase that question.
There's for Christmas trading, for December trading, it's 2 weeks and 2 words. You never trade past the second week of December, ever. There's just no...
That's more than 2 words.
No, there's two words.
Oh, I see.
Listen, son, listen. So never trade past the second week of December. And this December's no exception. As Dickie rightly pointed out, we've got non-farm payroll on the first Friday. As always, there'll be a lot of desks saying, right, that's it, we're done. And when I say desks, I mean the big institutional desks, the real money desks. Of course, the week after, the Monday, Tuesday, Wednesday, that's when the real wind down will be done. Book flattening off. Probably most of them will be done by the Thursday, Friday. They'll have skeleton crews on the desks. This might not mean a lot to most people, but these are the people making the big decisions for new money coming into markets, for real money going into trades. They won't be at their desks until after the new year now. Arno nailed it. You only trade over Christmas and New Year if you want to lose money. You might think you have an edge, and if you do have an edge, good for you, but the vast majority of people do not have an edge at the best of times, let alone over those illiquid markets, because those illiquid markets are not normal markets, and it's very important to know that. That's why a lot of algos and stuff turn off over the period, because the algos are they're taught or they're back tested on liquid environments. Christmas markets, New Year markets, very illiquid. But the 2 words I have for December and Christmas, New Year: capital preservation. That's all it's about. Regardless if you've had a good year, again, I'm echoing what my good friend Arno said, regardless if you had a good year or a shit year, just preserve what you've got, because you're not going to make more in the next, you're not going to make a significant amount in the next few weeks or over the period of the festive period, but you can lose a significant amount. It's that simple. Seasonality, you mentioned, that can do one. I just got no time for seasonality.
Points off for that.
It's just ridiculous. In terms of if you were to watch anything, and I think it's something, I know I keep saying this, but 10-year, and funny enough, it's what Munger and Buffett have always said, 10-year yields hold the key to everything. What drives those? It's market pricing of central bank policy decisions. although 2 years the better guide really on that in terms of US Fed policy. To which I have a question for Arno that maybe could all help us out with. See if he can pull any stats out of his arse about what the relationships are between the twos, as in the 2 years, and the SPOOs, the S&P. So I would like to see someone do some analytical work on the twos and the SPOOs.
Well, go on. There we go. Ryan's given us some homework for us to come back with.
Christmas homework.
Again, if I was looking to anything in the markets to drum up some headlines, whatever, I hate to say it. I really hate to say it, but it'd be crypto, because there's a good chance that we could be getting some more ETF news and stuff out before Christmas, before the SEC and all that lot break up for their jollies. So I know a lot of people listen to this will have an interest in crypto. For once, that's all. If I had one thing to look at, I'd be doing that, but I won't, because I got sent a lot of wine for my 40th birthday. Arno contributed 3 bottles to the cause, so I'll be drinking that over the next few. 4? Oh, it was 4. Oh crap! I've already drunk one.
Oh no! The postman had the other one.
If I'm not on trading blows over December, because I'm not sure if I am, I wish everyone a very Merry Christmas.
I'm sure you will be back before then, Ryan. I was very worried what your 2 words of advice were going to be. So when you said they were capital preservation,
I could have come up with so many others.
That was a great weight off my shoulders. Right, let's get on to the final scores. Very good timing there, Dick. You've got another wooden spoon to add to your collection to replace the one that you broke the other day. And Ryan, despite your somewhat disabled state, you have come home the victor. Well done.
I just would like to thank my mum, my dad, my family.
Cut him off now.
Right, yes, move on before he gives us the full acceptance speech. That does bring us to the end of another show. Thank you to the gents for joining me. Arno Venter from Capital Edge, Ryan Paisey from PiQ Suite, and Dick Matthews from One.io. Thank you very much to Kyriakos, our producer, as well, for bringing this chaotic scene together as well as he always does. We will be back with another show very, very soon indeed. If you've enjoyed the episode, drop a like on the video, leave a comment as well, and we will see you again in a week's time. Thanks again, and goodbye for now.